Hi friends, hi viewers of this particular channel. So today is a very interesting topic. We are going to cover a step-by-step method of how to create a financial plan. This will also fulfill one of the requests made by one of the viewers of the particular channel requesting for a goal-based financial planning, an Excel sheet which we are going to create in this video online so that you can create your own Excel sheet. Of course, if you still need that Excel sheet, I'm going to share it to you over a email channel or maybe a WhatsApp medium, whatever is convenient for you once you drop your comment in the description box. Before we begin, let me warn you that financial planning is very personalized. Each one's financial situation, financial background is very different. So because of that differences, though the goals and objective, though your financial goals and objective may be similar to n number of people, the way to achieve it could be very different. So I request you to use this video as a guideline to build your financial plan. However, also consult a financial expert so that you can take the guidance. There can be various options that can be tabled out to meet a financial goal. You might have various constraints during planning, and it is best to take help of a financial planner. So having said that, let's get on to our financial planning discussion. Before we move ahead into the Excel sheet, all the drama of the Excel sheet, and get eagerly starting our financial plan, let us see a brief overview of what are the steps involved. It's just a six-step framework, six-step framework involved. So let us understand each of these steps very briefly before we deep dive into the Excel sheet. So the first step obviously is to understand your goals. You need to understand what are your dreams. So that is the first and the primary step. The second step in the method is to understand what is today's cost of those dreams, and then also the timeline to achieve those specific dreams. Now, these dreams are other than retirement dreams. Retirement, as I said earlier, we are going to cover it in a separate video. I'm going to make a separate retirement planning video. So this video is focused to other than retirement. So the second step, cost and timeline, is required for each of the goals which we have listed in the first step. And the third step, we are going to see whether you have a surplus which is required so that you can invest. We are going to understand your income statement, we are going to understand what are your expenses and see what are the surplus which can be utilized for investment. Then the fourth step, we are going to see whether you have current assets available or any liabilities that can decrease or decrease your net worth to a certain extent. We are going to see how those assets can be used so that you can meet those various goals. So that is the fourth step. The fifth step, we are going to see different strategies, different options. Of course, there can be various options, option A, B, C, various strategies involved for achieving different goals. But however, in this video, we are going to keep it very simple, and this is one of the reasons why you need to approach a financial planner, because for a personal financial plan, you need to have various options on the table so that you can ease out your investment decisions. And then finally, the sixth step, execute. Let's execute the plan and achieve our goals. So are you ready to get into the Excel? So let us begin the financial plan. So let us assume, for sake of financial planning demonstration, let's assume the name of this person is Ramesh. Age of Ramesh is about 35 years old. His risk tolerance, whether he has insurance already, whether he has emergency fund already. We'll consider all these aspects when it comes to financial plan. Let's assume that Ramesh is fully covered with respect to insurance. He has sufficient emergency fund, which is going to last for at least 1 year. And now let us understand from Ramesh what are his goals. That is the first step of a financial plan. So let's do a little bit beautification for the Excel sheet. This is going to be the goals. And goals, you're going to keep it in white color, so it's visibly noticeable. So the first goal, Ramesh wants to buy an iPhone. Okay. The second goal, Ramesh wants to plan his marriage. Wonderful. The third goal, Ramesh wants a car. Okay, these are his goals, financial goals. We have not considered his retirement. Retirement is a completely separate planning altogether. For that, I'm going to prepare a separate video. So now these are his three goals. And as I said, as part of the financial plan, we need to understand the cost and the timeline for each of the goals. So let us see cost and time. So the cost of an iPhone he wants to purchase for today's cost is about 1 lakh rupees. The marriage plan which he's doing it for about 12 lakh rupees for himself. And the car which he wants to buy is about 16 lakh rupees. That is today's cost. And the timeline for buying the iPhone, he wants to keep it 2 years, let's assume. Marriage, he wants to plan after 6 years. And car, he wants to plan after 10 years. So the type of this goals, iPhone is a short-term goal. Marriage is a medium-term goal because lesser than 7 years. And more than 7 years, the car. So we are going to take it as a long-term goal. So once we have identified the cost and the time period for which the goal is required to be achieved, now we need to make certain assumptions. So assumption in terms of what is the inflation of the cost with respect to each of these goals in the future. That means after 2 years, what is the cost of the iPhone going to look like? Because he needs to spend that particular cost in the future. So inflation for iPhone, we are going to assume 7%. Marriage, we are going to assume inflation of 7% again. Car, we're going to assume inflation of 9%. Okay. And the return on investment. So that means to achieve these dreams, Ramesh needs to invest in certain assets. And because of the nature of the dream, which is a short term, we are going to invest in assets which are capable enough to suit those needs. That means for short term needs, we are not going to take too much risk. Hence, the rate of return, the rate of returns expected on that particular investment is going to be lesser. So we're going to assume about 8% ROI for investment made for a short-term dream. For medium term, we're going to assume 10% ROI. And for long term, we're going to assume 12%. This is the average conservative returns, nevertheless. Better to be conservative, better to be a little pessimistic, so that if it turns out to be that you have more at the end of the particular time duration, then you can use that money for any other goals for that matter, or you can just enjoy it for leisure purpose. So now that we have the inflation and ROI assumptions, let us now understand from Ramesh some quantitative analysis. So what is quantitative analysis? We are going to see shortly. We are going to see here quantitative QA and quantitative analysis. So in quantitative analysis, what we're going to see is we are going to check Ramesh's income and expense and determine whether he has a surplus which can be invested to meet each of these goals. And then we are also going to see what are his assets and liabilities look like. For the sake of this particular demonstration, we are going to keep it very simple. So we're going to have assets. We're going to start with income first. Income, we're going to have income from salary, active income. This income may be about 60,000 per month for 12 months. And then he has rental income because he's 35 years old. He had purchased a flat long ago on a loan. So he's getting rental of about 10,000 per month. That is 1,20,000 for the entire year. So the total of this income, we're going to sum it all up. And he's earning about 8,40,000 for the entire year. So this is his income. And now we're going to find out what are his expenses look like. Expenses. So his expenses for living is about 20,000 per month. This is excluding his rent. Rent, which is rent, will be about 12,000 per month, and any miscellaneous expenses is going to be MISC. Miscellaneous expenses about let's assume for this specific example 5,000 per month. So let's tally all this up, and we have 4,44,000 for the entire year. So what is surplus? Surplus. Let's have surplus here. This minus income minus expense, obviously. 3,96,000 is Ramesh's surplus. So now let us look at his balance sheet. Let us see whether Ramesh has any assets and liabilities. So let's make the asset bifurcation. Asset. He has a home, a flat. So he's already getting rental income. So the value of the flat is roughly about 60 lakhs rupees. Roughly dividend yield is about 2 to 2.5%. So I've assumed 2.5%. So today's cost of the flat is about 48 lakhs as an assumption. He has certain mutual fund investments being made in equity long term. And the value of that investment, let us assume, is about 1 lakh today. And now let us see his liabilities. Liabilities, he has nil EMI being paid, so no liabilities are of today. He doesn't have any loans to be paid. For the sake of simplicity, we'll assume there are no liabilities. However, it's not going to be the case in many cases, as a matter of fact. So if he's paying any EMI, then this EMI will be considered as part of the expenses. And his miscellaneous, here we consider miscellaneous. Miscellaneous could be like considered as part of EMI if he has any liabilities. But for this specific case, we have assumed nil EMI. If you want me to consider EMI as an example for financial planning, please drop a note and I will be glad to consider EMI as one of the factor for financial planning. So his net worth. Net worth is about all this sum minus sum of the liabilities. So 49 lakhs is what is net worth is. This flat is an investable flat because he's not staying in it. He's staying on rent. That is why we have considered expense, including rent. So this is his net worth. Okay, now we have considered his surplus, what can be invested. We have considered what are his current investments available for consideration for various goals. According to Ramesh, he doesn't want to consider his flat for any of the goals. But however, mutual fund, he is in a dilemma whether he should consider it or not. But nevertheless, he wants to understand first what are the investments required for each of these goals today to meet those goals in the future. So now we need to calculate what is his future value of the goal, future value. Based on the future value, we need to see what are the investments required today. So the future value, we have a formula called FV, which is future value. And then we punch in the inflation rate, which will tell us how the future value of that particular investment or that particular goal will look in the future. That means for iPhone, the 1 lakh, how it will look 2 years hence. So we're going to have 2 years hence. And then there is no monthly cost considered. This is just a one-time cost. So one-time cost, we're going to put it as, this is what the cost is, one time. And future value, 0 is at the end of the year. So this is what the future value of that particular goal is going to look like, 1,14,000. So similarly, we do it for marriage and we do it for the car. Now, let us give it a separate, slightly separate cell color. We now need to determine what are the yearly annual investment required. For simplicity, we'll see what is the annual investment. So annually investment, there is some formula called PMT, wherein we can identify what is the monthly investment to meet that future value or the particular goal. So we have, it is assuming that the return on investment, that is of 8%, is going to be achieved when we put that particular annual investment. So 8%, we're going to have 8% for invested for 2 years. That means every year we are going to invest. We don't have existing investment to be considered, but however, let's take a placeholder called existing investment. And then we have a future goal, which is of this value, 0. So now this is assuming that the investment will be made at the end of the year, end of the first year and the end of the second year. Okay. If it is at the beginning, we need to put 1. So we'll assume in this particular case, he's investing at the end. So if he has any existing investment goes from the pocket, so it's always minus. Okay. So existing investment. So right now, existing investment is 0 for this particular case. So we see that he needs to invest 55,000 at the end of the financial year. And then at the end of the second financial year, again 55,000. So 55,000 when he invests at the end of the first financial year will earn interest at the end of the second financial year. So this and then this, and we have no investments, no existing investments. So we keep one more row up. We total it all up. So he needs to invest 5 lakhs starting today. Now, planning can be deliberately, more complex. Not deliberately, it can be complex because if you see here, after 2 years, he'll have 55,000 available to be invested maybe for a medium-term goal. Or it could be utilized for another goal which maybe come up in the future after 2 years. It could be even utilized for a retirement plan, anything for that matter. So a financial plan needs to be reviewed and revised ideally after 6 months in a year. So now that we know if 5 lakhs is what he needs to invest starting today, but however, does he have 5 lakhs? He has just 3 lakhs 96,000. So then we need to ask Ramesh whether can he prioritize certain goals? Can he let go certain goals like iPhone? Can he purchase another type of a phone? But Ramesh is adamant he wants an iPhone. So he's ready to delay his iPhone. So let's keep it like 3 years. So then we have 4 lakhs 86,000 which is required. Still not sufficient. Ramesh says that he may get an increment in the subsequent year, but however, he's not sure. So hence, if he gets an increment, and it can be utilized for other goals. So, but for this specific example, Ramesh now thinks like, should he keep his marriage expense too high? Then he settles like he will go for a lesser marriage expense, which is of 10 lakhs, and he will keep his car a little compact size car, so which is about 10 lakhs again. So now we have 3,67,000 to be invested every year, starting at the beginning. So 3,96,000 is his surplus. So comfortable enough for Ramesh to invest that amount. So now if we have considered some existing investment, let's say Ramesh keeps in mind that he wants to keep 50% of his mutual fund investments into this specific buying of a car, then we can consider 50% of mutual fund. Then his, as you see, the annual investment goes a little lower. So if you, it was 3,67,000, that is now 3,58,000. So this is how a goal-based planning would look like. So we have all his goals. This is how annually Ramesh needs to invest. And this is what his expenses and surpluses and net worth looks like. So nevertheless, when you do financial planning, we need to also check the insurance and the emergency availability. When you consider insurance, it should be health as well as term insurance. There is a way to calculate health and term. There's a human life in valuator, which can determine what is the actual requirement of the insurance. So that's it with respect to goal-based financial planning. Hope this video will be useful to you. If you do need this Excel sheet, please drop in a note in the comment section, in the description section. And if you have any specific kind of a goal in mind, a different nature altogether, which you want me to consider for the planning sake, please drop a note in the description box and I'll be glad to consider it. Alvida. Bye.